Inventory. Let's go to question 20, which was fun in a lot of ways. This, by the way, as I announced towards the end of the class, comes from a CPA review course. I won't mention the name. They're very popular. They don't give refunds, but they do make a guarantee that you will find a new major very soon after you attempt the CPA exam. And this is what the CPA exam is going to be like in the future. It's a simulation. They're going to give you actual language, and that's what this is, actual language from Monsanto's footnotes, and say, based on what you see here, what does it mean? That's a great simulation. So what do they tell you? They tell you that on a FIFO basis, their ending inventory in year 11 would have been 186 million higher, and it would have been 111 million higher in 2012. So you just have to match up the years and realize that what they're telling you is that the difference between 186 million and 111, or 75 million, is the increase in inventory between 10 and 11 that would have occurred had what? Had they used FIFO inventory. So that's the question we're asking. Had they used FIFO, how would that have affected the financials? So if the ending inventory would have been higher by 75 million, what does ending inventory do? Higher number of ending inventory means a lower cost of goods sold and a higher net income, and that's basically what I'll be looking for. And in addition to which, part of C, I'll be looking to see that you apply the tax effect at 30%, so that the real bottom line to the net income is 75 million times actually 0.70 to get to the right answer, or you could have taken 75 million minus the tax effect to get to 52.5 million is the actual bottom line right answer when you get to the letter C of this question, as the overall effect that had on the net income if they had used FIFO. That's all it was. I mean, I know it's a lot of language. You have to read. You get scared. You get frightened. I watch you. I get scared and frightened, and so you panic. But that's what it's going to be like, those kinds of questions where it requires just reading, thinking it through. All right, let's see. The cost of goods sold, I think what I can do there, actually cost of goods sold, the use of cash for operations, I worked it out for the financial statements. Is that what this one's about? This one's the 21. This is the last one. So I have a a answer key that I wrote out. I'll send that out, and you'll see that what you were supposed to do, just to tell you how you're supposed to do it. It's not so simple, maybe, but you're supposed to start from the income from operations as your beginning point, and then do your pluses or minuses to get to your net. What pluses and minuses would you do? Well, you're going to use the accounts receivable, the change there, the change in inventory, and the change in accounts payable, and the change in other current liabilities, which is probably an expense. The notes payable I saw some people were using. I'm going to think about whether to account that or not, but technically speaking, the notes payable is part of financing, so it would not be used. So those four line items affect your operations, so you would take the net difference between those and add or subtract those to your income from operations. You should not have used the net loss, but that'll be partial credit. Why? Because that's not operations. What does the question ask? Is operating activities. So it's sort of logical. And that, my friends, is that in a nutshell. Isn't it? Any questions? Any comments? Or you want to scream and yell after I stop the recording? Help, please.